I have to be honest with you as we get started today.
Oh, yeah?
Yeah, because usually when I prep for these deep dives, I'm organizing my notes in a very, linear way.
Right. Very structured.
Exactly. Topic A leads to topic B. And it's academic, it feels safe, it's comfortable.
We definitely like order. Human brains love a nice spreadsheet.
Right. But looking at the stack of documents you sent over last night, the legal briefs, the flowcharts of the London markets, the DOJ settlement papers, I did not feel comfortable.
I don't blame you.
I felt like I was staring at a crime scene board. You know, the kind you see on TV with the red yarn connecting pictures of guys in suits to offshore bank accounts.
That is honestly the only way to visualize it.
Mm-hmm.
If you try to look at the silver market like a standard textbook economics problem, supply in column A, demand in column B, you're going to fail.
Yeah.
Math simply won't add up and you'll just end up completely confused and angry.
And that's exactly where I want to start today, that anger. Because we aren't just talking about high finance concepts in a vacuum. We're talking about a very specific, visceral frustration that I know thousands of you listening right now feel.
It's a very real pain point.
So I'm going to play the role of the rational actor today, the guy who did his homework, the retail investor who is just trying to build a secure future.
The person who logically believes that 1 + 1 should equal 2.
Right. So walk with me here. I look at the world and I see the fundamentals of silver. I start with the supply side. I read the mining reports coming out of Mexico from Peru, and the mines are drying up.
They are?
We aren't finding massive nuggets anymore. We're processing literal tons of dirt and rock just to get grams of metal. Yields are down across the board.
Global yield grades have been degrading for over a decade now. We are scraping the bottom of the barrel. The easy silver is gone. It's just a geological fact.
Okay, so supply is tight. It's physically hard to pull out of the earth. Then I look at demand, and, it's not just grandmas buying tea sets anymore.
Not at all.
It's the industrial engine of the entire future. Solar panels, they need silver paste. AI data centers, they need silver for conductivity. Electric vehicles, Tomahawk missiles, you name it.
It is the most conductive metal on the periodic table.
Yeah.
If you want a high-tech future, you absolutely need silver. It's what we call inelastic demand.
Meaning they can't substitute it.
Exactly.
Yeah.
Apple can't just swap out silver for copper without degrading the iPhone's performance. They have to have it, regardless of the price.
Right. So supply is down, demand is exploding. And on top of all that, central banks around the world are buying gold at the fastest rate in 50 years, which historically drags silver right up with it. So the fundamentals are screaming to buy. It looks like the easiest, most obvious trade in history.
It's a classic, perfect bull market setup.
So I do it. I take my hard-earned savings. I buy physical silver, expecting true price discovery. I expect the price to eventually reflect that massive scarcity. And this is the part that drives me crazy. I wake up on a random Tuesday morning. There's no breaking news. No war has suddenly ended. No massive new silver mine was discovered in Nevada. But I look at my phone, and the chart is just a vertical red line.
A total collapse.
Down 4%, down 5%. In 20 minutes.
Ah, yes, the Tuesday morning smash. We see it all the time.
It drives me insane. It feels like the entire market is broken. It genuinely feels like I'm sitting at a poker table where the dealer's just dealing from the bottom of the deck.
I'm going to stop you right there.
Yeah.
Because you hit on the absolute key word. You said broken.
Yeah.
The market isn't broken. It's not a glitch. What you're experiencing is a highly engineered, highly efficient machine. It's just that the machine isn't designed to find the true price of silver.
Then what is it designed for?
It's designed to manage sentiment, transfer wealth from the impatient retail investor to massive institutions, and maintain the illusion of overall currency stability. What you are calling a glitch is actually a weapon system working exactly as intended.
Okay, that is a really heavy claim. Calling it a weapon system implies intent. It implies there's a target.
And that is exactly what we are here to prove today. The thesis of this briefing is simple, but it's very disturbing. The spot price of silver, that glowing number you check on your phone, has almost nothing to do with the physical metal we just talked about.
Nothing to do with it.
Almost nothing. It is not determined by the scarcity of the element in the Earth's crust. It is determined by digital derivatives, pools of dark money, and institutional obfuscation.
Obfuscation, which is just a polite Wall Street word for lying.
We're going to be completely forensic today. We're going to unmask the hidden hands. We'll explain mechanics that sound incredibly complicated terms like naked shorting and rehypothecation, and we're going to show you that they are actually just fancy, legalized terms for counterfeiting.
And we've got the receipts for this. Because I'll be honest, this sounds borderline conspiracy theory. If I go to a dinner party and say, hey, the big banks are rigging the silver price, I sound like a crazy person.
We have federal court documents. We have the actual Department of Justice settlement with J.P. Morgan. We have admissions of guilt. This isn't a theory on a message board anymore. It is legal history. And the wildest part is, it's still happening right now.
All right, let's go straight to the scene of the crime then. I want to understand where this is actually happening, because when I check the price of silver, let's say it says $28.50 an ounce, I naturally assume that price is being set by people buying and selling actual silver.
And that is the very first illusion you have to break. That number on your screen, the spot price. It is not the price of a physical silver coin.
Right.
Because if you walk into a local coin shop in Texas or a bullion dealer in Zurich right now, you cannot buy an ounce of silver for the spot price.
Yeah, pay premium.
Yeah, I'd pay maybe $32 or $33. The real physical price is always higher.
Exactly. So if the spot price isn't the real price of the physical object, where does it come from?
Where is it made? It's manufactured in two primary arenas, and neither of them deals primarily in physical metal. The first is the COMEX in New York, which is the futures market. And the second, which is much bigger and even more opaque, is the LBMA Over-The-Counter market in London, the OTC.
The OTC. I kept seeing that acronym in the reports you sent over. Over-the-counter. It sounds so harmless, like I'm just buying aspirin at a pharmacy. It sounds accessible.
It is intentionally boring. They want it to sound mundane so you don't look too closely at it. But think of it this way. When you buy a regular stock, let's say you buy shares of Tesla, you go through a public exchange like the NASDAQ.
Sure.
You can see the daily volume. You can see the bid and the ask. It's transparent. It operates in the sunlight.
Everyone sees the exact same tape. If some massive whale buys a million shares, we all see the big green candle on the chart.
Correct. The London OTC market is the exact opposite of that. It is a closed network of private bilateral contracts between massive institutions.
Who are we talking about?
We're talking about the bullion banks.
Yeah.
Names like J.P. Morgan, HSBC, central banks, and enormous hedge funds. They trade directly with each other behind closed doors.
So it's literally just a private conversation. Like one bank says, I'll sell you this much silver at this price, and nobody else gets to see it.
It is a dark pool. There is no central clearinghouse standing in the middle to verify that the asset actually exists before the trade happens.
Wait, really?
Really. In a normal, regulated public market, the exchange makes sure you have the goods or the cash. In the OTC, it's heavily based on credit. It's just a gentleman's handshake between financial giants. And this complete lack of physical verification is exactly where the dark money enters the system.
Okay, how much money are we actually talking about here? Because if it's just a few guys trading back and forth, does it really have the power to move the global price?
This is where the forensics get truly damning. If you look at the clearing volume, the sheer amount of quote-unquote silver being traded in London every single day, it is astronomical. Some days, the London markets trade the equivalent of 300 million ounces of silver.
300 million ounces in a single day.
In one day. Now, let's do the math based on what we talked about earlier.
Yeah.
The entire planet Earth, every single mine in Mexico, Peru, China, Russia, all of them combined, only pulls about 800 million ounces of physical silver out of the ground in a full year.
Wait, pause. Let me get my head around this. We mine 800 million in an entire year. That is the hard cap on reality, but they are trading 300 million in a day.
Sometimes more. In a busy week of trading, the London and New York markets will trade more silver on paper than has ever been mined in the entire history of human civilization.
That is impossible. It's physically impossible. You physically cannot move that much metal around the world.
It is physically impossible. Which brings us to smoking gun number one. They aren't trading metal. They're trading paper. They are trading digital promises, betting slips. They're essentially trading the concept of silver.
So the price discovery mechanism, the entire system that decides if my real physical investment goes up or down, is based on the velocity of these digital betting slips, not the actual inventory of the metal itself.
Precisely. The spot price is simply the clearing price of the derivatives. It's the tail wagging the dog. Actually, it's worse than that. It's the shadow of the tail wagging the dog.
But why does that matter? I mean, if I bet on a horse race, my bet doesn't physically slow down the horse. Why does betting on paper silver drive down the price of real silver?
Because in this specific casino, the market algorithms treat the paper ounce and the physical ounce as completely identical when calculating supply.
They count the ghosts as real people.
Exactly. Basic economics 101.
Yeah.
If you massively increase the supply of something, the price goes down.
Right. Supply goes up, demand stays the same, price drops.
So if you have a massive shortage of physical silver, which is highly bullish, but you have the power to print 10 billion ounces of paper silver out of thin air and just dump it onto the market,
You've artificially flooded the supply. The pricing algorithm sees a massive surplus, and it drops the price.
and that is exactly how you crash the price of a scarce physical asset.
Yeah.
You dilute it with infinity. You cannot have a shortage of something that you can print on a keyboard.
Okay, I want to get really mechanical here. Diluting with infinity sounds poetic, but how do they practically execute this? You mentioned naked shorting earlier. I hear that term thrown around on Reddit, on finance Twitter all the time. It sounds incredibly scandalous. But what does it actually mean in the context of the COMEX?
Let's break it down step by step. Exactly. You need to locate the asset. But in the futures markets, specifically for the massive bullion banks, there is a structural mechanism that effectively allows the naked short.
And what makes it naked?
This is when a commercial bank sells a futures contract, which is a legal promise to deliver 5,000 ounces of silver at a specific future date without actually having the silver in their vault to back it up.
They are selling a promise they literally cannot keep.
They are selling air. They are selling a legally binding contract that says, I will deliver this silver, but they have absolutely no intention of ever delivering it. They have the intention of buying back the contract before the delivery date arrives. They are purely speculating on the price direction using massive, massive leverage.
But isn't that just straight up illegal? You can't just sell things you don't have. If I sold a house I didn't own, I'd go to federal prison.
In the commodities market, it is permitted under the guise of market making and hedging. The banks argue that they are simply providing liquidity to the market.
Liquidity. That is always the banker's favorite excuse. Oh, we're just greasing the wheels of commerce.
But look at the scale of what they do. We see what we call concentrated short positions. This is when a few massive banks, sometimes just 4 or 8 individual traders, hold a short position that is larger than the entire available physical inventory of the COMEX vault.
So if everyone on the other side of that trade stood up tomorrow and said, okay, I don't want cash, deliver my actual silver.
The bank is bankrupt. Instantly. The metal simply does not exist to satisfy the claims.
So the banks are basically playing chicken with the entire global market.
It's way more aggressive than playing chicken. It's a calculated ambush. Let's go back to your random Tuesday morning crash, the one that drove you crazy.
Yeah.
We call this maneuver the 0.01 second harvest.
Spooky name. How does the harvest work?
Picture this. You are a bullion bank. You want to buy physical silver, but you want it cheap. Or, more likely, you are currently holding a massive short position and the price is rising, which is causing you to bleed money. You need the price to go down to save your own position.
Okay, so I'm highly motivated to smash the price. I have to stop this rally right now.
Exactly. You wait for a moment of exceptionally low market liquidity, usually around 3:00 a.m. New York time, or during that gap between the London market closing and the New York market opening.
When the volume is paper thin?
Right. Most human traders are asleep or at lunch. Nobody is watching the shop.
Okay.
Then you execute a massive coordinated dump of naked shorts. You throw 5,000 contracts onto the market in a fraction of a second. That single order represents 25 million ounces of silver.
Just a massive, terrifying wall of selling pressure.
Now remember the high-frequency trading algorithms.
Yeah.
The AI bots that basically run the modern market.
Yeah.
They see this massive spike in supply hitting the tape. They don't know it's fake paper. They don't know the vault is empty. They just see a massive sell order.
And the robots panic.
The robots completely panic. They are programmed to follow momentum. So they start selling their own positions instantly just to beat the incoming drop. And this creates a cascade, a waterfall event. The price drops 3, 4, 5% in a matter of minutes.
And here's the real tragedy for the retail guy.
The retail guy is fast asleep in his bed, but he has a stop-loss order on his trading account because he's a responsible investor. He set a rigid rule that says, if silver drops below $27, automatically sell my position to protect me from further losses.
And the flash crash slices right down to $27.
His broker automatically liquidates his position. He gets completely washed out. He is forced to sell at the absolute bottom. And who do you think is standing right there to buy it?
The exact same bank that started the crash.
Exactly. They dumped fake paper to crash the price, flushed out the real owners, triggered the stop losses, and then bought back their short positions to cover at a massive profit. Or they scoop up the physical long positions at a steep discount. It is a harvest. They are literally harvesting your stop losses.
That is, I mean, that's theft. That's not a free market. It's rigging the game.
It's highly efficient if you happen to be the house. And this leads us perfectly to the second weapon in their arsenal. Because naked shorting is all about selling what you don't have. But rehypothecation, that is a whole different beast. That is about loaning out what you do not own.
Oh, boy. Rehypothecation. I tried to read the formal definition of this yesterday, and I swear my brain just tried to shut down to protect itself. It sounds like dense legal jargon specifically designed to make normal people stop asking questions.
That is exactly by design. If they called it double spending or duplicate collateralization, the public would revolt. But rehypothecation sounds like a routine, boring dental procedure.
So strip away all the banking jargon for me. What is it in plain English?
We are going to use an analogy today that will make it impossible for you to ever forget. I call it the Wall Street coat check.
Okay, I'm listening. Paint the picture for me.
Imagine you are going to an incredibly exclusive club in Manhattan, and you are wearing a one-of-a-kind, solid silver jacket. It's heavy, it's incredibly valuable, and it belongs completely to you.
I'm looking sharp. I'm feeling good.
You walk in the front doors, and you go straight to the coat check. You hand the attendant your silver jacket. He takes it, hangs it up safely in the back vault, and he gives you a little paper claim ticket. Ticket number 001.
Standard procedure. That ticket is my legal claim. I need to hold on to that to get my jacket back at the end of the night.
Right. So you go inside, you sit down, you order a steak, you're enjoying your night. But the manager of this club is greedy. He goes into the back, and he looks at that silver jacket hanging there. He knows you're going to be eating dinner for at least 3 hours. And he thinks to himself, why let that massive capital sit idle? That is a valuable asset doing absolutely nothing.
I really don't like where this manager is going with this.
He goes over to the office Xerox machine, and he makes a perfectly identical copy of your ticket, ticket number 001. And then he walks out into the crowded bar, finds another guy, and sells that copy ticket to him for $500.
Wait, he just sold a claim on my specific jacket.
Yes, he did. Now, there are two completely separate people in the club who both firmly believe they own the exact same silver jacket.
And I'm just eating my steak, totally oblivious.
You have no idea. But he doesn't stop there. He goes back to the copier, and he prints out another ticket, and another. He prints 400 tickets.
400 tickets for one jacket.
This is the reality of unallocated storage. When you buy silver through a standard bank account or through certain retail trading apps or large unbacked ETFs, and the fine print in the user agreement says unallocated, you are buying a Xerox ticket. You are what the law calls a general unsecured creditor. The bank is using one actual physical bar of silver as collateral for dozens, sometimes hundreds, of different paper liabilities.
But how does a scheme like that not just instantly collapse?
Because the 400 people never walk up to the coat check and ask for the physical jacket at the exact same time.
Oh.
They just trade the paper tickets with each other. Hey, the price of silver is up. I'll sell you this claim ticket for $550. Sure, I'll buy it. The paper market flourishes. Everyone feels rich looking at their account balances. But the physical reality in the vault hasn't changed at all. There is still only one jacket.
But what happens when the fire alarm goes off in the club?
Exactly. That is the ultimate systemic risk. If there is a sudden crisis, a geopolitical shock, a massive spike in industrial demand, a true run on the bank, and all 400 people run to the coat check to demand their physical property.
The very first guy in line gets the jacket.
And the other 399 people get absolutely nothing. Or, more accurately, they get a cash settlement based on the bankruptcy proceedings of the club, which might be paid out in depreciating fiat currency at pennies on the dollar months later.
So rehypothecation artificially expands the supply of silver claims, which suppresses the real price, while secretly creating a massive, catastrophic systemic risk that no one actually sees until it's far too late.
That is the defining characteristic of the modern silver market. It works perfectly right up until the second it doesn't.
Okay, I can already hear the skeptics right now. I can hear the listener who is pausing this and saying, okay, guys, this sounds like a great script for a financial thriller movie. But this is the global financial system. This is highly regulated. The SEC exists. The CFTC exists. You're talking about massive, coordinated, systemic fraud. Is this just a really well thought out conspiracy theory?
I love that question. I really do. Because for a very long time, it was treated exactly like a conspiracy theory. People who pointed this out were called gold bugs or tinfoil hat wearers. They were completely dismissed by mainstream financial media. But we have decisively moved from theory to cold, hard fact.
We have the receipts.
We have a federal record. We need to talk in depth about the 2020 Department of Justice settlement with J.P. Morgan Chase. Because this wasn't some minor civil suit over a paperwork error. This was a massive criminal investigation.
This wasn't just a slap on the wrist, was it?
No. J.P. Morgan officially agreed to pay a record-breaking $920 million fine. Nearly $1 billion.
You do not pay $1 billion to the federal government if you did nothing wrong.
You absolutely do not. And it wasn't just a fine where they deny wrongdoing. It was a deferred prosecution agreement. They formally admitted to the conduct.
And what exactly was the conduct they admitted to?
Manipulation of global markets for precious metals, specifically gold and silver, as well as Treasury securities.
I want the granular details on this. This is the true crime part of the dive. Who were the actual guys doing this? Was it just some rogue, low-level intern sitting in the basement hitting the wrong buttons?
Not at all. It was the absolute top of the food chain. It was the global head of the precious metals desk, a man named Michael Nowak, and his lead trader, Greg Smith. These were the top guys, the absolute masters of the universe.
And what were they actually doing day to day? Was it the naked shorting we just talked about?
It was a very specific, aggressive, tactical variation of it called spoofing. And the amazing part is we have their internal chat logs. The DOJ released them in the court filings.
What did the chat logs actually say?
They were brazen. They would literally type things into the chat like, I'm going to spoof the gold market up right now, or we need to push silver down, get ready to spoof. They were openly calling their shots like Babe Ruth.
Okay, explain spoofing to me. Like, I'm sitting at the table holding the cards.
Let's go back to the poker table analogy. Imagine you're playing high-stakes poker, but you are the only player at the table who has an infinite, unlimited pile of chips. You look at your hand. It's garbage. You want to scare all the other players into folding so you can take the pot? So you aggressively shove a massive, towering pile of chips right into the middle of the table. A ridiculously huge bet.
Everyone else looks at that mountain of chips, they get terrified, and they fold.
Right. But in spoofing, right before the dealer actually reaches out to take your chips and lock in the bet, you yank them all back. You never, ever intended to actually make the bet. You just wanted the psychological reaction from the other players.
How does that actually work on a digital trading screen?
The traders at the bank would place massive, overwhelming sell orders for silver futures on the exchange. Huge, visible walls of selling pressure. Let's say 500 contracts sitting right there on the ask side of the order book.
Okay, so the rest of the market looks at the screen and sees this massive wall.
And remember, the high-frequency bots, the algorithms, they scan the order book thousands of times a second. They see this massive sell order suddenly appear out of nowhere.
Yeah.
And they calculate, oh no, a massive whale is about to dump a ton of silver. The price is about to crash.
And the computers panic again.
Exactly. The algorithms start front-running the perceived crash. They start selling real contracts instantly. This genuine selling pressure drives the actual price down. The fake spoof basically creates a real, self-fulfilling prophecy.
So the real price drops solely because of the threat of a massive sale that hasn't even happened yet.
Correct. And then once the price drops down to exactly where the bank wants it, the bank instantly cancels all of their fake sell orders. They pull their chips back off the table before the bet is executed.
Wow.
And this is the absolute kicker, the way they monetize the crime, they buy the real physical metal or the long contracts at the artificially suppressed price that they just created.
So they scare the price down with a ghost order, buy the very dip that they manufactured, and cancel the ghost order so it costs them nothing.
That is the exact definition of spoofing. And the DOJ investigators proved with digital forensics that they did this tens of thousands of times over the course of nearly a decade.
Tens of thousands of times. This wasn't a one-off trade. This was their fundamental business model.
It was so deeply systematic, so embedded in the culture of the desk, that the DOJ actually used the Arcane Act to prosecute them.
Wait, Arcane NOCO? As in the Racketeer-Influenced and Corrupt Organizations Act, like they use for the mob?
Yes. They legally classified the precious metals trading desk at J.P. Morgan as a criminal enterprise. That is a legal label almost exclusively reserved for the mafia and drug cartels.
That completely blows my mind. Arkham case on a Wall Street trading desk.
It proves beyond a shadow of a doubt that the market is rigged. It is a casino where the house can look at your cards, print infinite chips, and spoof the dealer whenever they want.
Yeah.
And this brings us all the way back to that feeling you described at the very beginning of the briefing.
The anger.
That frustration. It is completely justified. The reason your portfolio is bleeding on a random Tuesday is not because you were wrong about the fundamental scarcity of silver. It's because you are sitting at a table playing against a completely rigged deck.
Okay, but here is the devil's advocate question again. They got caught. They paid the $920 million fine. The traders got sentenced. Is it over? Did they actually stop doing it?
You have to look at the profit incentive. If you make an estimated $20 billion rigging a global market over a decade, and then you eventually get caught and have to pay a $1 billion fine, is that actually a punishment?
No.
Or is that just a commission you pay to the government?
It's literally just the cost of doing business. It's an operational expense.
Exactly.
Yeah.
And until the fundamental architecture of the market actually changes, until regulators step in and completely ban naked shorting, until we demand real, physical audits of the London OTC dark pools, the massive financial incentive to keep doing it remains exactly the same.
Okay, so we have established the crime. We have clearly identified the weapon. We have seen the smoking gun with the DOJ fine and the RACO charges. Now comes the most important question for anyone listening. What do we actually do? If I'm a listener and I'm currently holding silver or I'm thinking about buying it, how do I survive this? How do I make sure I don't become the victim of the next harvest?
You have to start applying a very strict filter to every single precious metal asset you own. We can call it the 2026 filter, looking ahead to where this entire system is inevitably going.
Okay.
You have to ruthlessly distinguish between a paper claim on metal and the reality of the metal itself.
Paper versus physical,
Yeah.
the ticket versus the actual jacket.
Exactly. This is the single most critical takeaway from this entire dive. If you are currently holding paper silver, and unfortunately this includes most mainstream ETFs, margin trading accounts at regular brokerages, and unallocated bank accounts, you are deeply vulnerable to the crash.
Let's talk about the ETF specifically for a second, because a massive amount of retail investors own SLV. It's the biggest silver ETF out there. It's easy to buy in a retirement account.
If you actually sit down and read the dense legal prospectus of SLV, it is very clear. It is primarily designed for what they call authorized participants, which are the massive bullion banks to basket swap paper contracts back and forth.
Right.
It is absolutely not designed for a retail investor like you to ever take physical delivery of the metal. If the paper system crashes, you cannot take your shares to New York and redeem them for silver bars. The prospectus legally allows them to just settle your account in cash.
And if the cash they give me is essentially worthless because of hyperinflation or a currency crisis,
Then you lose. You perfectly called the macroeconomic bet, but you lose the actual prize.
So, actionable intelligence here. What is step one for the listener?
Step 1. Reject unallocated storage completely. If you log in and look at your statement and it clearly says unallocated, or if you call customer service and you can't get a straight, legally binding answer on where your specific bars are located, you are holding a counterfeit coat check ticket.
So sell it. Get out of it.
Exit the position.
And move the capital to what?
You demand allocated storage or pure physical possession, the absolute best case scenario for survival. You hold the physical metal yourself, you have it bolted in a heavy safe in your house, you physically hold the silver atoms, because in this environment, if you can hold it, you truly own it.
The old saying, possession is 9/10 of the law.
In the modern silver market, possession is 10/10 of the law. There is absolutely zero counterparty risk if the coin is literally sitting in the palm of your hand. No bank can spoof it away from you.
But what if I have too much to reasonably keep at home? I mean, I don't want $1 million of silver buried under my mattress. That's a huge security risk.
That's a valid concern. In that case, you need to use segregated, fully allocated, private, non-bank vaults.
Non-bank, that's the key operational word there, right?
It is critical. You want your wealth to be completely outside the traditional banking system. You want a vaulting facility where there is a very specific physical bar stamped with a specific serial number that legally belongs exclusively to you, not a generic fractional claim on a massive pool of metal. You want a pure storage contract, not a financial derivative instrument.
This instantly reminds me of the Singapore strategy that we teased a while back on the show. Why is Singapore always brought up in these conversations?
Because this is exactly what the ultra-wealthy, the billionaires, are doing right now to protect themselves. Singapore has incredibly strong property rights. They have zero capital gains tax on investment precious metals. But most importantly, it is a sovereign jurisdiction that is completely outside the Western banking sphere of influence.
So if the US or Europe suddenly decides to change the rules or tries to confiscate gold, or if the heavily leveraged Western bullion banks totally collapse,
Your hard assets are completely safe. They're sitting in a maximum security facility in Changi, thousands of miles away from the chaos of Wall Street. The billionaires are actively insulating themselves from the inevitable paper avalanche.
because they know that the decoupling is coming.
The decoupling is the ultimate endgame here. Eventually, the brutal math of reality wins. Eventually, the physical shortage of silver out of the mines becomes so painfully acute that the massive industrial users, Apple, Tesla, the defense contractors building the missiles, they will demand physical delivery.
Right, Apple can't build an iPhone out of a COMEX futures contract.
Exactly. They don't want paper derivatives.
Right.
They need the raw element to keep their factories running.
And when those massive tech giants demand actual physical delivery, and the COMEX vault opens up and the banks say, sorry, we only have paper tickets left.
The price forcefully decouples. The paper spot price on your screen might crash to zero, or the trading might be permanently halted by the exchange. The screen might literally go blank, but the physical price, the actual premium you have to pay a guy to get a real silver bar in your hand, will completely skyrocket to match its true scarcity.
It really comes down to the fundamental difference between price and value.
Correct. You cannot outtrade a major bank's supercomputer. You cannot beat their billion-dollar high-frequency algorithms at their own game, but you absolutely can outlast them. You have the power to just opt out of their rigged casino entirely.
By holding real atoms instead of digital digits.
Precisely. That is the only way to win.
This has been, honestly, it's been a little frightening to walk through, but it's also incredibly clarifying. It makes all those frustrating red days on the chart finally make sense. It stops the psychological gaslighting.
It completely removes the confusion. Once you see the matrix, when you see the price magically drop on absolutely no news, you don't panic sell anymore. You just realize, the paper market is doing its thing. The code check guy is in the back office printing more fake tickets today.
Right.
It actually validates your underlying thesis rather than challenging it.
Okay, let's wrap this up with something for the listener to really chew on. Because we started off talking about the desire loop, that deep human need for truth and fairness in pricing.
And at its core, that is really what this entire forensic dive is about, truth. The Scott market right now is essentially a lie wrapped in a derivative hidden inside a computer program.
So here's the question I want to leave you with today. We talked heavily about that $920 million fine against JP Morgan. And isolated, sounds like an ocean of money. But compared to the billions in profits they quietly made off you, was it?
That is the truly provocative thought we have to confront. Is a financial fine enough of a deterrent? Or should the mechanism itself be completely outlawed? If we legally know that naked shorting violently suppresses the price of real physical commodities, commodities that human beings desperately need for green energy, for medical technology, for the future grid, why is it legally allowed to exist for another second?
Should any financial entity be legally allowed to sell millions of ounces of something they do not actually own?
I think anyone with common sense knows the answer to that. But I will leave you with this final, stark warning. It is the single most important thing I can say to anyone listening today, and I genuinely want you to write this down and stick it on your monitor.
Go for it. Let's hear it.
If you are currently holding paper silver, you are not holding an asset. You are holding the unsecured liability of a bank that is actively betting against you.
A bank that is actively betting against you. That honestly chills me to the bone.
The future belongs entirely to the owners of the physical world, not the paper ticket holders.
On that note, I think it's time to check your portfolio. Check your vaulting agreements, read the fine print, and make absolutely sure you aren't holding a losing ticket when the fire alarm goes off. We will see you all on the next deep dive.
Stay safe out there. Keep your assets real.